Welcome to the Explainer. Grab your coffee because today we're getting right into the mindset of a professional currency trader. We're going to break down the actual mathematical mechanics of global foreign exchange. If you've ever found yourself wondering how those trillions of dollars flowing through the FX market are actually priced and how traders are constantly hunting for these microscopic market inefficiencies, well, you are absolutely in the right place. Let's get into it. Okay, let's dive into this. Here's a question. Is there actually such a thing as riskless profit in global finance? I mean, it sounds like a total myth, right? But in the incredibly high-stakes world of currency trading, the mathematical relationships between exchange rates and global interest rates create these rigid boundaries. And when those boundaries get crossed, it opens the door to something known as arbitrage, which is basically a guaranteed risk-free profit. Today, we're going to learn exactly how that whole mechanism works. Here's our roadmap for today. First, decoding FX quoting conventions. Second, calculating currency cross rates. Third, the arbitrage relationship. And finally, number 4, forward discounts and premiums. Mastering these building blocks is really going to unlock some professional-level insights for us. Starting right off with Section 1, decoding FX quoting conventions. Before we can even start hunting for those market inefficiencies, we have to understand exactly how traders read and speak the language of currency pairs. At its core, every exchange rate is just the price of one currency expressed in terms of another. We call these the base currency and the price currency. The base currency is always set to exactly 1 unit. The price currency, which you'll sometimes hear called the quote currency, tells you how much it costs to buy that one single unit of the base. So say you see USD/EUR at 1.1700. The euro is the base and the US dollar is the price currency. That simply means 1 euro costs exactly 1.1700 US dollars. Now, picture this. Imagine you're a currency trader sitting at a really busy desk in Paris. For you, the euro is your domestic currency. If you're looking at a direct quote, your domestic currency, the euro, is acting as the price currency, and the foreign currency is the base. Basically, you're looking at how many euros it takes to buy exactly 1 British pound. An indirect quote just flips that entire perspective around. Your domestic currency becomes the base currency of exactly 1, and you're measuring how many foreign units that single euro can buy. So it really all depends entirely on where you're sitting. Let's move to Section 2 and see how this builds, calculating currency cross rates. So, what happens when you need an exchange rate between two currencies that aren't actually directly traded with each other on the primary market? You build a cross rate. Calculating a cross rate is honestly just like solving a logic puzzle. Step 1, you identify the exchange rates you already have in front of you. Step 2, you might need to invert one of those quotes to get the currencies aligned correctly. Taking the inverse simply means calculating 1 divided by the spot rate. And then step 3, you multiply the quotes together so that the common middle currency just cancels itself out, leaving you with the exact rate you're looking for. Let's visualize how this fractional cancellation actually works. If we want to find the price of Canadian dollars per euro, which is the CAD/EUR cross rate, but we only have the dollar Canada and euro dollar rates, we just multiply them. Notice how the US dollar is sitting in the denominator of the first fraction and the numerator of the second. Just like grade school fractions, they cancel each other out perfectly, leaving us with CAD over EUR. It's brilliant. Moving on to Section 3, the arbitrage relationship. Now that we know how these exchange rates are built, we've arrived at kind of the grand unifying theory of the foreign exchange market. It's the mathematical glue that connects spot rates, forward rates, and global interest rates. Remember that cross-rate math we just did? Well, if those calculations didn't hold up perfectly in the real live market, it would create an instant opening for triangular arbitrage. Let's say our calculated cross rate for Canada yen is 85.97, but some misguided dealer quotes it at 86.20. Traders, and honestly mostly automated algorithms, would instantly buy at the lower price and sell at the higher price. They'd exploit this tiny discrepancy for riskless profit, which is literally the unicorn of finance, infinite free money. And they'll do it until the sheer force of all their trades snaps the prices right back into perfect mathematical alignment. And this brilliantly illustrates the core arbitrage equation that governs forward rates. The math states that the forward rate, F, must equal the spot rate, S, multiplied by the ratio of the two countries' interest rates. Specifically, that's 1 plus the foreign interest rate divided by 1 plus the domestic interest rate. If this equation doesn't balance perfectly, boom, a riskless arbitrage opportunity exists. This formula proves something super important. A forward exchange rate isn't some magical market prediction of the future. Not at all. It's simply a strict mathematical function of today's spot rate and the interest rate differential between two countries. So why does this formula hold true? It comes down to a process called swap financing. You can think of it as the ultimate no free lunch mechanism. See, an investor can either invest their money safely at home at the domestic risk-free rate, or they can convert their funds to a foreign currency, invest at the foreign risk-free rate, and guarantee their return trip by locking in a forward contract today. If one option magically paid more than the other, traders would just borrow in the cheaper market and invest in the richer one, making guaranteed money with literally zero of their own capital. Swap financing is what strictly enforces the boundaries of the formula we just looked at. Let's head into our final section, number 4, forward discounts and premiums. Now that we've got the unbreakable math behind forward rates down, let's look at how trading floors actually quote these differences in practice. On professional trading screens, you usually aren't going to see the full forward exchange rate typed out. Instead, you'll see quotes in forward points, or pips. To get these points, the market simply takes the difference between the forward rate and the spot rate and multiplies it by 10,000. This scales that tiny decimal difference up into whole numbers that are just much easier to read and trade quickly. Oh, and as a quick side note, for Japanese yen pairs, they only multiply by 100, just because the yen is already quoted to 2 decimal places, not 4. These points actually tell us everything we need to know about the relationship between the currencies. If the points are positive, it means the forward rate is mathematically higher than the spot rate. In trader speak, the base currency is trading at a forward premium. Conversely, if those forward points are a negative number, the forward rate is less than the spot rate, which means the base currency is trading at a forward discount. Now, what's really interesting here is how the absolute number of forward points escalates across time. For the spot rate of 1.15885, the 1-month forward points are just positive 27.1, but look at the 12-month row. It jumps way up to positive 364.7. Because forward points are fundamentally driven by interest rates, the absolute number of points scales proportionally with the time horizon of the contract. It makes sense, right? More time means more accumulated interest, which means more forward points. So let's say you're sitting at your desk and a dealer quotes you those 12-month forward points of positive 364.7. How do you find the actual forward exchange rate? Well, you just reverse the math. You take the points, divide them by 10,000 to unscale them back into a decimal, and then you just add that back to the spot rate. So 1.15885 plus 0.03647 gives you your exact forward rate of 1.19532. Pretty simple once you see it laid out. So the absolutely crucial point here is this. Regardless of how the currencies are quoted, the currency with the higher interest rate will always trade at a forward discount. I'm going to say that one more time because it's that important. The higher interest rate currency trades at a forward discount. Why? Because to prevent that free money arbitrage we talked about earlier, the currency paying a higher interest yield must mathematically depreciate in the forward market to perfectly offset the extra interest you earned while holding it. And conversely, the lower interest rate currency trades at a forward premium. It's a perfectly balanced scale. We've covered a tremendous amount of ground today, from base currencies and cross rates to the strict mathematical boundaries of swap financing and forward points. But I want to leave you with one final, kind of provocative thought. If the arbitrage formula dictates exactly what the forward rate must be, and if algorithmic trading immediately closes any mispricing, where does the human trader actually find their edge? Think about it. The answer lies not in out-calculating the machine on today's math, but in forecasting the underlying economic forces that will shift those interest rates tomorrow. Thank you so much for joining me for this explainer, and hey, keep looking for those edges.